Okay, this is our first video of, I believe there's going to be 4 on corporate allocations. Now, hardly anyone is using corporate allocations, so because of that, I'm not putting quite the effort in editing of these videos, and also not even the effort in developing the expertise needed. Normally when I make a video, I like to think I know all about every aspect of the thing that I'm making the video about. Well, what we're going to have to do is use these videos to sort of get started and then encounter the problems that we encounter and solve them together, including the idea of getting some consulting help from N4. If we have a challenge that we don't know quite how to solve, we'll get them to teach us what we need to know. But this is enough. These 4 videos will be enough to get almost any strong-hearted Sun Systems person going. Okay, and so here we go. Corporate allocations. The first thing that you need to understand about corporate allocations is the parts of, what it does, not the parts, but what it does. I think the strongest position that you can come from to become an expert at corporate allocations is to know what N4 asserts that it will do, and then start thinking creatively about how you can apply that in your organization. The most obvious one and the coolest one, I think, is to apportion expenses. For example, if you want to charge electricity expenses to other functions. So when we pay the electricity bill, we charge it to one function, say in-house operations, and then we want to break it into other functions. We can do this with groups of bills. For example, we can take all of the charges to in-house operations and allocate them out. What comes to mind is ADRA, allocating out its central office, its office bills to all of its programs, and so that would come to mind. We could charge a certain faculty member's expenses to various departments. We could apportion all the costs in one fund or function to other funds or functions. Sort of redundant, but that's what I said a minute ago. Or we could apportion all the costs in one business unit to another business unit. And it will also help in those cases, and this is an important distinction we'll work on, those cases the cost of residing one place, and we want to make an entry moving them from that one place to some other place. And that would, almost any place we can put cost, we can move between those places to using corporate allocations. But another thing that it will do is it will look at the expense at one location, or revenue at one location, and use that as a basis for making a related entry. For example, with commissions or royalties, where you would like to look at the sales of one book and pay the author a certain percentage of those sales, making a whole freestanding entry debiting commissions expense, a royalty expense, and crediting payable. We could pay for the certain number of students that we've gotten, the revenue from a certain students. We could pay it to a student recruiting company. We could do the same with literature evangelist sales. So this would be the first example of the previous slide was say a credit to an expense and a debit to expense someplace else, some other function or fund or some other business unit. Well, this one looks at the expenses and takes it and makes another related entry based on the expenses it sees. And in both of these cases, the same thing could be done with revenue. If revenue comes in at one location and you want to allocate it, or if you want to base a entry off of revenue, it can be done. Okay, the third example is calculate interest. Okay, you calculate interest on certain accounts on average daily balance, and this works both ways. If we want to charge interest, or if we want to record the payment of interest, that can be done based on average daily balance. Okay, we could apply interest to allocated functions such as scholarship funds according to a prescribed rate. And we could allocate interest to various allocated functions such as scholarship funds based on actual interest earnings. All right, so these two seem pretty similar. One is the first one on the slide here, but it would be the second one on the list. The second one on the list is that we want to say give 5% to all of our scholarship funds. The third is we want to take the balance in an account and of interest income and allocate all of that interest income based on relative size of the scholarship funds, and we could allocate all of the balance of a certain income account to different scholarship funds. Okay, and the third possibility, and actually I think I'm on 4 now, sorry. On our fourth possibility is that we want to increase or decrease budgets, certain budget accounts. For example, next year we want to increase our budget by 10%. We don't have to do all of this budget download, upload, and re-upload. All we would have to do is to do a corporate allocation that increased it by 10%. And now here is a one I think is a very interesting one, and we have it demonstrated in one of our examples. You know, at Mission College we had a cafeteria, and we had a budgeted revenue for the cafeteria, and we had budgeted cost of food for that cafeteria. Well, in fact, you know, that's really sort of silly, because if we really want the cost of food to be, the budget for cost of food to be a percentage of whatever their sales are, we don't want to limit them to that budget. You know, if they do really good job selling, you don't want them to be trying to keep within a food budget based on a lower sales amount. You want to support their increased sales with an increased budget. And so this example is that we agree that cafeteria sales could be something like 40% of the cafeteria revenue. Cafeteria budget for cost of food would be, let's say, for example, 40% of the cafeteria revenue. And so every month you would revise their budget to be 40% of their revenue. And that's very easily done, and is demonstrated as one of our examples. Okay, and then our final one is other. The Infor literature makes a big deal about how it's perfect for performance and activity-based costing, and I don't really understand what they mean by that, but if you are familiar with performance or activity-based costing, you might be able to come up with a good example that'll help you implement. Okay, so let's go ahead and get going into the elements. There's two types of allocations, and I've already hinted at them, or basically I've already explained them. The first one is called a splitting type. A splitting type is where we take an account, revenue or expense account, and we want to move or split the contents of that account into other funds, functions, business units, or something else. So we're taking what's in an account, writing an entry that basically reduces that account, and then increases or puts that cost some other place. It could be into another account, it could be in the same account but into a different function, or it could be into a different fund, a different business unit. Okay, so basically the principle here, and I'm not sure whether it's explained well, but the principle here is that an entry is made against this account to change it, okay? And so, for example, the example I gave with the electricity earlier, the electricity account would be the source, okay? And we're learning jargon here. The source means something, okay? The electricity account is the source, and it is split between different departments, okay? So the electricity entry went into the account into one function, and then we want to split it between different departments. That would be the target based on floor space. That would be the allocation ratio. Okay, so those are two new terms: the source, the target, and the allocation ratio. The source is the account that we are affecting by the splitting entry, moving the contents of it to the target, and we're doing that based on what is referred to as the allocation ratio. Okay, the basis of that movement, okay, is called the allocation ratio, and that's a split. We're moving around stuff, cost or revenue. And then another example is we're allocating security expenses. All the costs in the security function, okay, that is security department, which is the source, are allocated to all the other departmental functions, that is the target, and based on the number of employees. That's the allocation ratio. A third example, the balance in the retirement expense account, that's the source, is split between different who's, that would be the targets, based on the annual salary of the who, and that would be the allocation ratio. Okay? All right, so those are all three examples of splitting types where we're moving cost or revenue, and where we're moving it from is called the source, where we're moving it to is called the target, and we're doing it based on the allocation ratio. The other type of allocation is a charge type. The charge type allocation does not affect the source. The source is used in the calculation as a basis of the calculation, but it is not affected. Okay? And so the account that serves as the basis for the allocation is called the source. Okay? The target are the two accounts or more that are affected by the allocation, and it's done based on the allocation ratio. Okay, so I might not have made this clear in the splitting type, so I'm sorry if I get a little confusing. And the splitting type, we move it from the source to the target. So that's the source is one half of the entry, and the target is the second half of the entry, second part of the entry, and the split is based on the allocation ratio. And the source is not affected by the entry. Okay, the source serves as a basis for the allocation. Okay, the target defines both the accounts or more, but it has both sides of the entry of the allocation. Okay, and the allocation ratio is determined to be what amounts are made in the allocation between the target accounts. Okay, so the sales account, okay, the sales account for a certain book, let's say, is the source. Okay, the sales revenue figure for that book is multiplied 10%. That's the allocation ratio, and the result is debited to royalty expense. Okay, this is the commission. This is the royalty to the author. Okay, the royalty expense, and that's the target, and in the target is also the credit accounts payable, the target offset. Okay, so the entry is completely defined by the target in a charge type. Okay, the sales account is purely used in the calculation. The sales amount is multiplied times the allocation ratio to get the amount of the entry, and then the target defines both parts of the entry. Okay, let's look at another one. Interest payment for revolving fund accounts. Okay, so we look at the balance of the depositor. Okay, that's the source. It serves as the basis for the allocation. The source is multiplied, say 10%, which is the allocation ratio, and the result is debited to interest expense and debited into the depositor accounts, which is the target offset. Okay, the target defines all the elements, all the accounts of the entry. Okay, another one, cafeteria budget. The source is the sales of the cafeteria, and we decide that it's going to be 50%, and we want to revise the budget so it is 50% of its sales figure, and so 50% would be the allocation ratio. Food expenses in ledger B would be debited as the target, and the target offset would be credited using the entry that we normally use to record a budget. So the target defines both the debits and the credits. So I hope that we are clear on the difference between those two. A source, let me get back here a little bit so I can show you a little bit more. There we go. The splitting type, one half of the entry is defined, it is the source. It is being changed by the allocation. The source is used in the calculation as far as the amount that is being moved. It is moved by the allocation, is multiplied, the source is multiplied times the allocation ratio, and the source is debited or credited, and the target gets a debit or credit. And the charge type, the source is used in the calculation, but the target defines both the debit and the credit. Okay, so we'll get back, our slides catch us up here. And so let's review the components. The source. In a splitting type allocation, the source is part of the calculation and is split to the targets. In a charge type allocation, the source is part of the calculation, but its balance is not split to the targets. Okay, it's just the source. In a charge type, the source is just part of the calculation. The target is not part of the calculation, and either one of them really. It receives amounts based on the calculation. In a charge type allocation, the target offset is the balancing account in the entry. Okay, so this slide is not as great as it could be, but the target, if it is a split type, the target gets the balancing entry in tandem with the source to make the entry. If it is a charge type, the source gets no entry, the target defines both parts of the entry. Okay? And the allocation ratio is basically the same, the same concept, whether it is the source, if it's a splitting type or a charge type. Okay? And it can be almost anything you can conceive. It can be a fixed amount, 6%. It can be a fixed amount, $5,000. Every month you want to move $5,000 from one expense to another, or from $5,000 from one function, allocated function, to another. Okay? If it can be a proportion, okay? So you put in the floor space or whatever and proportionate out the expense based on the proportional expense. And it's not shown in the slide here, but I'll make an emphasis of this while we're doing the presentation. The allocation ratio is kept track of in a memo account. Okay, don't worry about it. I'm going to show it to you. But the memo account can be set up So the calculation, the allocation ratio is based on the balance of a memo account for various things, or the transactions for the month. Either the allocation can be based on either one. So you could have the floor space as the basis of the allocation, and every time the floor space changes, either the size of the floor space or the usage by the different departments, you would write an entry to record the change. And then it would look at the balance of the floor space in each department and do the calculation based on that. Or you could write an entry every month that records the floor space for that month, and it would do the allocation based on that. Either one can be set up. You have that option. So let's say you want to allocate interest rates based on some percentage, amount. Okay, you could put the change in interest rate in, and it would look at the balance. Okay, or each month you could record the interest rate that you wanted to use in the calculation, and it could be set to look at that. So I know that's a little confusing, but that's what the examples are for. Okay, so now those are our components, and so let's look at the way the elements inside the software. So these are the functions inside the software that we are going to become masters at. Okay, the first one is allocation sources. Okay, and it defines the source. Second one is allocation ratio, and it defines the ratios. And then the third is target, and it defines the targets and the target offsets if it is a split type. If it is a charge type. Okay, and then the allocation setup pulls those first three together. It pulls together the source, the ratio, and the target for a particular allocation. And so it is reasonable, it's a moment to speak about this, is that the allocation setup, the source, ratio, and target can be multitasked to different allocations. The easiest example is the allocation ratio. The allocation ratio, for example, floor space, could be used in an allocation that is allocating electricity expense, and it could be also used in allocating security expense, just as well. Okay, so the same ratio set up would be used in multiple allocations. Well, the same could be true with allocation targets. Okay, if you are targeting the operating department, the supporting departments, you're wanting to allocate the supporting department costs to the operating departments. Okay, electricity would be allocated, and security be allocated, and housekeeping being allocated to the operating departments like School of Business and the education department and so forth. Well, the target would be the same in all of the examples and would be have multiple uses in multiple allocation setups. Okay, so one allocation setup needs to have all three, but they can be used over and over again in different allocation setups, mixed and matched the way you need them for a particular allocation. So that process of defining a source, ratio, and target and setup, if you know what you're doing, would take 10 or 15 minutes. Okay, if you don't know what you're doing, it could take a couple hours of trial and error and getting it right. But once you get it right, and here is the important thing, once you get it right and ready to run, then you run it each month, and that takes 2 minutes. That's the beauty of this whole solution, is that once you get an allocation set up working the way you want it, then all you have to do is run it, and it does a huge amount of work for you in just a second, in just a minute. Okay, so you define your source, ratio, and target, pull them together with a setup as a major project, as an afternoon project, and then you run it as a routine thing, and it happens really rapidly. okay, including the allocation calendar, which can automatically do a run for you if you really wanted this thing to be slick. Okay, and I believe a few observations. The interplay of those three things is that you're going to name your source. You create a source, and it's like a Sun Systems record, you know, where you name it and it asks, it does not exist, do you want me to create? You are going to create a ratio, okay, and you're going to create a target, okay, same process. You type in the name, it asks, you want us to create it, you see, and then the setup pulls together those three name components, okay, and like I said, they could be used multiple times. So this example on the screen here is exactly the one I just described a second ago. Okay, you can also do multi-layer allocations. I do not have an example of this, but it's very simple. This allocation thing is set up to do it where you have one allocation and then it runs again with a different, for example, let's say you allocate security department expense based on, you allocate electricity based on floor space, and that includes the security department gets a charge for floor electricity, and then then you do an allocation of the security department to the other departments based on personnel. Well, you can stack these allocations up so that you can do multiple allocations in sequence. Okay, so you allocate one layer which puts costs into some departments, and then you allocate another layer which takes those costs and allocates them to other departments, and so forth. Okay, and I just use the simplest is thinking about allocating the cost of expenses, but we could be to departments, but you could also be allocating from almost any place to any other place in multiple layers. Okay, and the allocation run, okay, that you run is very similar to the ledger import behavior that you do when you're importing doing ledger entry. Okay, that is, it gives you an error message. It has a report that goes with it that gives you the errors, and if it's successful, it gives you a JV, and it can be automatically run using the calendar. Okay, but when you're doing the allocation run, think ledger imports, almost exactly the same behavior. Okay, let's see if we can, and then that's it for our presentation. Now we have 4 examples that I want to show you. 3 examples that I want to show you. The first 2 work perfectly. And every time I make a presentation, I sort of stumble around a little bit, you know, with the idea that it just works perfect, you know, because I edit out the mistakes or practice it until it's working perfectly. Well, in the third presentation, it didn't work perfectly, and instead of editing it all out and all, I thought it'd be useful for you to see the process of having mistakes made and struggling with the mistakes. So the first 2 are 2 beautiful examples that work great, and the third is not such a beautiful example, but it gives you sort of a sense of what a non-working one and the process that you go through to make it work. And so I hope that is helpful. Stay tuned to the rest of these on corporate allocations.